everybody. Luke Gromen, FFTT. Hope everybody is well and had a great weekend. This episode of Two Things That Grabbed My Attention Recently, brought to you again by FFTT Tree Rings. A quick testimonial about tree rings from Eric. Thanks, Luke, for not featuring politically biased viewpoints in your newsletter. It's so refreshing and not annoying compared to so many I see on FinTwit. We, or at least I, am investors, are investors at the end of the day. So appreciate that feedback, Eric, and thanks for being a subscriber. We're going to jump right in now into a couple of things that grabbed my attention recently. The first is something we tweeted last week, which is that from May to February, we've had Hong Kong unrest, we've had the swine flu, we've had chicken flu, now we've had coronavirus, and yet the yuan dollar remains at 7, roughly, which is interesting because in the same time horizon, the gold to oil ratio has risen 60%, 60%, from 20 barrels per ounce to 32 barrels per ounce. And what this describes is ultimately two things. First off, perhaps the release valve that so many are looking to take place for China in the currency is taking place in the gold or in the gold to oil ratio. And I think this is a perfect example of why we've been calling the yuan oil contract a game changer all along, which is that if you have both a yuan oil and a yuan gold price, and you have a dollar oil and dollar oil price, the ratio between the two should, according to the law of one price, which is that you can't have two different prices for the same thing, the ratio between the two should be constant. It should be the same. To the extent that China needs to manage their current account, pretty much every yuan bear and FX analyst more broadly looks at two things. They either have to devalue the currency or they have to sell down FX reserves. And historically that's been true. The yuan oil contract changes that because now they can effectively change the composition of their energy bill, buy more in yuan in theory if they have a willing seller, which increasingly it appears they do. Or within that, they can effectively increase the gold to oil ratio in the yuan side, which would then force all else equal, especially up until summer of last year when gold was being capped in dollars effectively by someone at around $1,300 an ounce, a bigger gold to oil ratio in yuan would drive a lower dollar oil price, and then suddenly lower dollar oil price, higher current account surplus. You can see here what this does is it gives China a third lever to manage their current account balance that most people aren't discussing. And so I think that's a really important thing. And then broader, we talked about the gold to oil ratio being a gauge of the health of the petrodollar system, and that's because basically a healthy petrodollar system is a low gold to oil ratio. Gold is cheap, so it doesn't compete with treasuries. Oil is relatively expensive. That way it generates excess dollar surpluses that get recycled into treasuries. Low gold, high oil, low gold to oil ratio. If that starts rising, the gold to oil ratio that is, that's a sign that the petrodollar system, broadly speaking, is under stress, and that's happening. Ever since 2010, the gold to oil ratio has gone from 6 barrels per ounce, roughly 6 or 7, to 32 now. And 2010 was roughly when Russia really started ramping up gold purchases in their FX reserves, oil buying gold. Anyway, let's jump into the next thing here. We tweeted, Mike Bloomberg noted that Trump has proclaimed infrastructure week 7 times and never gotten it done. Setting aside anything specific to Trump or Bloomberg, what we think Bloomberg and pretty much everyone else in Washington is ignoring, the elephant in the room, is that infrastructure week was replaced a long time ago by Entitlement Century. And Entitlement Century was started by FDR with Social Security, continued by LBJ with Medicare, Medicaid, and then added on to by George W. Bush with Medicare Part D, combined with an aggregate lack of political courage throughout the whole time period involved. And so we've got 100 to 200 trillion in shovel-ready projects ready to go, and that money's going to have to get printed. It's the Fed that's going to be shoveling a lot. So I think that's important to understand as we're watching the context as we get into this political season. This is an elephant in the room that Washington just doesn't want to deal with, but they're going to have to. Okay, 2 quick questions here. First off, from Darren, if the curve is inverting, why does Treasury not issue more long-dated debt? This would save some of the constant rolling and the issues with repo. The interest rate on the debt isn't much more expensive at that end yet. Great question, and I think it's an important clue. It's an important case of the dog that didn't bark. If you read Sherlock Holmes, the dog that didn't bark, the sign was, when the dog didn't bark, they knew that the criminal was known to the dog and the homeowner. So this is a case of the dog that doesn't bark. So let's take a walk back in time to 3Q14. Back then, if you look at the Treasury Borrowing Advisory Committee report from that quarter, it shows that the weighted average maturity of total U.S. Treasury debt outstanding was, call it 68, 69 months, and it was forecast to move up and to the right at a 45-degree angle. In other words, the plan at that point is they were going to do exactly what you say, Darren, which is term out everything as far as they can. Makes sense. 3Q14, unfortunately, was also when global central banks stopped growing their holdings of treasuries, unbeknownst to the Treasury Borrowing Advisory Committee at that point. Over the next 5 years, central banks would buy net less than 0 treasuries. And that's important because when we go forward 5 years to the 3Q19 TBAC report, same chart, weighted average maturity, is actually flat to down. In other words, despite plans that the weighted average maturity would move up and to the right, that they would term the debt out, they actually weren't able to. Despite that, the fact that the bid for duration from 3Q14 to 3Q19 was the strongest in 5,000 years. Rates were the lowest in 5,000 years, and the U.S. government actually lowered weighted average maturity after global central banks stopped buying treasuries. And so there's two possible outcomes or two possible reasons then why weighted average maturity fell, to our view. Number one, Treasury didn't realize somehow that the bid for duration was the strongest in 5,000 years, which strains credulity, or the bid for duration from the U.S. Treasury was disproportionately made up of global central banks, and that global central bank bid disappeared in 3Q14 to a large extent on a net basis, and therefore the U.S. government had been forced to the short end of the curve to get these deals done. And we think that's more of what it is. So, long-winded answer, but it's an important question, and so we'll watch from here. Second question from David. China opening banks in Saudi Arabia. Is that a signpost? I absolutely think it's a signpost. Whether it's been Saudi oil shipments to China up 47% year over year last year, they're forecast up another 10% this year, year over year. Whether it is Dubai opening a yuan-denominated gold contract, whether it is the Saudis in 2017 saying they're considering funding in yuan to balance out the yuan, or diversify the funding basis of Saudi Arabia, whether it's we look at the Aramco IPO and suddenly we see yuan balances, and they're small, they're not enormous, but they're there. I don't know where else they would get those yuan balances in the Saudi Aramco financials. But the point is this. China is the biggest oil importer in the world. They are Saudi's biggest customer. They're every oil importer's biggest customer, basically. And it strains credulity to think that ultimately Saudi won't do what they have to keep their biggest customer happy. And to keep their biggest customer happy, that is likely going to require Saudi to sell oil in yuan. And so, to me, I think it is a big signpost of an ongoing process, and not the only signpost. These have been happening. They've been coming fast and furious, both in the financial and in the geopolitical world. So it's definitely something we're watching. So with that, I'm going to jump off for today. I hope everyone has a great week. As always, you can check us out at FFTT-LLC.com for more information about tree rings and other things we're up to. Otherwise, everybody have a great week, and we will talk with you soon, everyone. Take care.